Palantir continues its domination in 2025, outperforming the S&P 500 index, reporting 10.4% increase in its stock price in the previous month, while the S&P 500 has only returned 2.6%. The company signed some major contracts, including the one with Boeing and the UK Ministry of Defense, and that led to an even further increase in investor enthusiasm in Palantir stock, if you thought that enthusiasm couldn't get any higher. In this video, I'm going to review the latest developments, look at Palantir's longer-term success, and update my recommendation and rating on Palantir stock.
I want to thank The Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
One of the reasons why investors have been so excited about Palantir stock is because of the company's re-acceleration in revenue growth in recent quarters. You can see that uptick here in 2023. It had a certain slope of revenue growth going all the way up until 2023, and you can see that bit of acceleration here since 2023, since the launch of its products, since the launch of AIP has worked so well for Palantir. Overall, since 2018, Palantir has grown revenue from $600 million to $3.4 billion. That's good for a compounded annual growth rate of 31%. In the last month, the company got big deals from Boeing and from the UK Ministry of Defense, highlighting the company continues to win strategic contracts and add billions of dollars to its backlog. Remember, when Palantir signs a contract, it doesn't immediately go into revenue. It first goes into its commercial and government backlog, which then eventually becomes revenue as the company performs whatever it was it agreed to in the contracts it signed. But perhaps more impressively is just how much Palantir's profitability has been increasing. The company has done a great job of controlling costs, and the relatively asset-light business model allows this company to generate super premium prices for its services and still expand its profitability. Its return on invested capital, one of the most important metrics I consider when I'm making an investment, has soared from negative 130% all the way up to 49.8% in the most recent trailing 12-month period. One of the things I consider when I'm evaluating a company's return on invested capital is dividing the ROIC by the WACC, which is the weighted average cost of capital. I calculated Palantir's weighted average cost of capital at 17.6%. So if you divide the 50% by the 17.6%, you'll have an ROIC to WACC ratio of close to 3-1. That's a very strong ratio. A general rule of thumb I use is if a company has an ROIC that's greater than the WACC, I look at that as an attractive business. It's a business that's increasing shareholder wealth because it's generating more returns on the capital that it's using than it costs the company for the capital. So in that way, it's increasing wealth. Palantir is increasing wealth almost threefold for every dollar it invests in the company's products and services. As I shared with you, the weighted average cost of capital calculation is part of my fair value calculation for Palantir stock. The intrinsic value per share, which I updated this morning, has increased to $51. But unfortunately, Palantir's success and its incredible business model is no secret to any investor. The current share price is at $179, which, according to my calculation, looks to be meaningfully overvalued. Even when I consider the forward price to earnings ratio, it trades at a forward PE of 241, which is just about the most expensive this stock has been according to this valuation metric, going all the way back to January of 2023. So regardless of how I evaluate Palantir's valuation, the stock looks expensive. And that's one of the case the bears make against Palantir. We all agree. Well, I wouldn't say I'm a bear on Palantir. I think it's a great company. I would love to own Palantir stock, but I just think the valuation makes the risk versus reward unattractive for long-term investors because most of that upside that investors expect from the company over the next several years looks to already be priced into the current market price according to these valuations. Forward price to earnings of 241. That's remarkable. And then if you look at my DCF calculation, the price is over 3 times my intrinsic value per share calculation. And I'm forecasting robust growth in the company's forecasts in free cash flow. I'm estimating the company's free cash flow will increase from 1.9 billion in 2025 all the way up to 33 billion by 2034. So a significant increase in its free cash flow I'm forecasting over these next 8 to 9 years. Furthermore, I'm forecasting Palantir will achieve a longer-term growth rate of 6%. This is among the highest of any of the companies that I've conducted a cash flow valuation for. I think Tesla is the only one I have forecasted at a higher longer-term growth rate than Palantir. And even applying a 6% long-term growth rate still suggests this stock is overvalued. Now, one argument you can make is the weighted average cost of capital of 17.6% is too high and needs to be adjusted lower. Now, I can understand the suggestion, but the company's beta is at 2.6. The price volatility of the stock price compared to the S&P 500 index has been 2.6 times that level. So that is incorporated into my weighted average cost of capital with the cost of equity at 19.6%. So if you were to adjust this rate lower, that would result in a better valuation because this is the denominator I use to discount the expected free cash flows from now until 2035 and the very long term. Still, it would require a lot of adjusting just to bring the valuation down to affordable levels where it would even be considered a fair value. So all of that being considered, I'm not rating Palantir stock as a buy. I'm keeping it rated as a hold, and I'm updating that recommendation on September 29th. Hey everyone, I'm excited to announce that my book is finally available for sale. I've been working on it for more than a year now, so I'm really excited to finally share this with you now. It goes through my framework for evaluating stocks. Some of you often ask why I like this stock or why I like the other stock, and this framework provides you the things that I look at when I'm evaluating stocks. I've added the link in the description below.